On social media today, we hear the narrative around trading plans. Today, we're going to actually teach you and show you how to create a trading plan for yourself. So the first consideration that we're going to talk about is risk management, okay? So naturally, everyone's trading style is going to be very different, okay? So you've got swing traders, there's day traders, scalp traders, etc. So naturally, everyone's quantity of trades and style of trading will be very generally different, okay? So naturally, when you're trading with risk management, you should have a total risk daily tolerance, okay? So total risk tolerance per day allows you to mitigate the changes or the differences in your trading strategy while also having a total risk barometer that you aim for every day. And normally we would say 2 to 3% is a sufficient total daily risk amount. Anything above that, you're going to start going into potential overtrading narrative and potentially putting your account into risk, particularly if there's a period or a bad trading day visualized. Okay, so the second element of consideration beyond the total risk daily allowance is your risk per trade. Okay, so this differentiates risk per trade. This differentiates the style of trader you are. So naturally, if you're a swing trader, you might only be taking a couple of trades a week. If you're a scalper or a very, very short-term time frame trader, you're going to be trading maybe 5, 10, 15 trades per day. So naturally, the more trades you have per day, the lower the risk amount per trade should be. So if you trade, for example, 10 times a day, on average, you should be doing 0.2 to 0.3% per trade. If you trade, let's say for example, you're a day trader and you take maybe 2-3 trades a day, you can afford to then do 2-3 times. You can afford to do 0.5 to potentially 1% per trade, okay? So in total, you're still following a strategy of being able to manage risks in an accordant fashion, but also simultaneously making sure that you don't over leverage, don't put your account in risk due to that potential overtrading rule or overtrading narrative. After we look at risk management as our first key principle of the trading plan, now we're going to go beyond that into a deeper level. So the second thing we're going to focus on today is fundamentals, right? So fundamentals then allows you to look at the additional non-technical narratives associated with trading plans. So fundamentals could be the economic calendar. So naturally, every day as you're trading, you're going to have data events, you're going to have news, you're going to have information flowing continuously on a constant basis. So as a trader, it's important to be able to navigate around that. So if you're carrying a position or maybe a couple of positions through a data print that could be high volatility, for example, NFP, FOMC, or any of these major events, it is important that you are strategically placed to manage that risk, but also at the same time being able to understand the present dangers that's in front of you. So economic calendar, I think, is strategically one of the most important aspects of the trading plan because it allows you to control the risk, it allows you to control the narrative, and allows you to have absolute control over the balance of your account. And when you have that, it allows you to have a much clearer psychological tendency. In addition to the economic calendar, you also need to look at market correlations. So market correlations looks at the linear relationship between different assets. So if you're trading, let's say, indices, you're trading foreign exchange, FX assets, and you're cross trading, which means you're trading maybe two assets from a different range at the same time, it's important that you understand the correlations, so therefore you're not doubling or increasing exponentially your risk variations. So simple market correlation would be associated to the dollar fundamentally, potentially gold as a second asset, or indices. So you talk about the S&P 500, the NASDAQ, Wall Street, US 30, and even the European indices to boot. So when we look at market correlation, you obviously look at the DXY. In short, simple terms, DXY, gold, and of course the equity markets. Now, there is additional markets you can take into consideration like bonds, treasuries, even the VIX. So the VIX is another one that I use personally because VIX allows me to look at the actual day-to-day volatility, coupling in the fact that you're also taking into the consideration of the correlation of these assets. The third element of consideration is now your technical factors, is the ability to look at price action, different indicators, and so on and so forth. So 3 for me: price action, is the first protocol or element or factor that I would look at. Okay, so with price action, you've got time frame analysis, and of course you have trend analysis. That looks at the style of your trading. Are you short time frame? Are you higher time frame? Really just depends on you. So if you're a higher time frame trader, higher, you're going to be looking at really from 1 hour, 4 hour daily up, or if you like to do top down analysis where you start at the higher time frames and work down, you can do 1 week, 1 day, 4 hour, and potentially 1 hour if your risk tolerance allows it. So that allows you to really look at from a higher time frame perspective down, or if you're a day trader, shorter time frame trader, you're really looking at then your potentially 30 minutes, 15 minutes, 5 minutes, and if you're really brave, you can also look at the 1 minute chart, obviously depending on the nature of your strategy. So this allows you to focus on your strategy, what do you want to do, how do you want to trade, and of course different strategies will have different hooks, right? So if you're trading higher time frames, you're probably more a macro trader, right? You're looking at fundamentals, you're looking at not what's happening on, let's say, a news break today, but potentially what's happening 2-3 months down the line, and looking at the cycles into that. If you're looking at a shorter time frame approach, you're probably looking at ICT, you could even be scalping news. So it really just depends on you as a trader, right? The next thing then beyond the time frame element of consideration is the trend, right? So you could have a higher time frame trend. On a lower time frame, it could be a pullback, it could be a bearish correction. So it's important to understand that all of these time frames have different trend cycles built into them. So the trend cycle on a 1 hour time frame will be different than a trend cycle potentially on a 5 minute time frame. So it's important that you differentiate the two relevant to the style of strategy that you're implementing. So the fourth element that we're going to bring in now beyond the initial trend and time frame is price action. So that for me will be the additional tools that you look at. So retail traders, institutional traders, they look at different things. So me personally, I look at order flow and liquidity, but some traders might use MACD, RSI, support and resistance, whatever it is, supply and demand. So these other tools will be really kind of dependent on you as an individual. So I'm just going to put some examples down here. MACD, the tools itself, these will be individually based depending on what you feel is helpful for you as a strategy, right? Some of these are leading indicators. As I said, order flow and liquidity gives me data in real time. Some of these secondary tools are confluences, but they're retrospective, okay? So that for me is important as well. Depending on what strategy you're implementing really impacts upon what tools you use for your trading plan itself. So the final aspect of building a trading plan is then reinforcing everything that we've talked about in the prior 4 sections and building entry confirmations, because entry confirmations is the narrative or the idea of what you're taking and why you're trading it, okay? So 5 for me is entry confirmations, and this is going to be the style of trading that you're using, right? So there's different trading styles. You've got even simple strategies, break and retest. Other considerations might be ICT. So we talk about ICT traders now are becoming very, very popular in the retail market. Some use smart money concepts or SMC, which similar in a lot of ways. The higher time frame approach, so more macro basis. So you've obviously got macro. Others might just be trend, simple trend analysis. What I would say is when it comes to the style of trading that you're implementing, regardless of the style you're using, that you've very clear entry confirmations. If you have 2 or 3 entry confirmations that is the core of your strategy, well then all the better. So if we use the break and retest strategy as an example of this, right? So if we have a price chart, price action breaks up into a clear top and breaks above, simple retest would be price action coming back down to retest the breakout. So this area here is what would be the resistance area in retail trading terms, breaking out, coming back down, looking for that retest on the breakout, and then looking for the continuation. So that's obviously a sample example of the break and retest. If we were to look at, let's say, one that isn't there, and one that I use is order flow and volume. This is one that I use myself. If we have price actions up and down, we break out, we've got a cluster volume range here. So a common example that I see quite often is the apex, which is A's and V's. So we see an A, price action breaks out, and immediately or in the following trading days, depending on the time frame, breaks back down to the volume area. So if this, let's say, is a 100-point range, and we break out aggressively, generally speaking, the crossover in sentiment will try and return to the value area. So the value area is where most of the volume is located on the session itself. So whether it's on a weekly time frame or a daily time frame. So the apex is that type of scenario where we break out and incrementally we pull back to the value area. So it's not indirectly too dissimilar to break and retest, but on this one, rather than a support and resistance line, you're actually looking at volume. You're looking at where markets are most presently trading at and looking for that movement back down into that volume area. Same can be said for the V. It's just basically the inverse. So if, for example, we're trading and we break down, like markets tend to do sometimes, you're then looking for markets to come back up to this volume area, right? So this is where volume's most heavily traded at. You're looking for a market reaction, you're looking for that movement back up, and then it's a case of, do we actually break off that? And if we do, you then get your next phase lower. So again, you're breaking the breakdown of the structure, the trend movement, the movement back into the volume area, and then you're looking for that continuation lower. So volume profile is a very, very useful tool for that one. In this segment, we've given you two examples, two different trading styles, uniquely very, very different, but very, very clear principles. So on a daily basis, there's two words that I've repeated through most of this segment is if and when. And if something happens, when will I react? And being able to react accordingly to that. So I hope these different elements that we've talked about in today's video helps you build a creative trading plan for you that works best for your needs. Remember, it's not a one-shoe-fits-all approach, so everyone's trading style will uniquely be very, very different. So don't worry if different people's trading plans are very, very different to yours. It's a personal approach.